Let me preface this video by thanking every single one of you for subscribing to my channel for the last few months. I know that the 200 subscriber milestone is nothing compared to some of the bigger channels here, but for me it's an absolute incredible milestone to achieve, and I couldn't have done it without you guys, so thank you very much. And in the 200 subscriber post that I made here on YouTube, I got a recommendation from one of you guys to have a look at the company of Rubis, which is a company that I've never heard of before, and it's located on the Euronext of Paris. Rubis deals with supplying energy safety and the best possible economic conditions throughout various business models like distributing, storing, and now also producing reliable energy. So let's have a quick look over their financials and see exactly what Rubis has been up to for the past 10 years. I do think it's important to note that Rubis does not extract energy themselves, they mainly distribute it and supply it, and recently they also started a renewable section of their company to also produce their own energy, but we'll get to that in a little bit. So just looking here at their revenue numbers, we can see that they started with 2.7 billion in revenue in 2013, which they increased all the way to 7.1 billion here in 2022, an annual growth rate of about 10% annually. Of course, it has to be noted that much of that growth is here in 2022 because of course we did see an energy crisis here in Europe, and therefore the price that Rubis could ask for their products very much increased. I do expect this number to come down here in 2023, but it definitely have a nice spike here in 2022. EBITDA is also following in line with their revenue growth, even growing a little bit faster, which is very nice to see. This means that overall in the past 10 years their EBITDA, so their profit margin, has increased, which is also what we see on the left hand side of my table here. 8% profit margin in 2013, 9% profit margin in 2022. And in all the years in between that, we also saw them at 12, even 14%. So I do definitely imagine that they can actually increase their profit margins here in the future as well to be more in line with these numbers, because even though they had a record earnings and record revenue, their margins were compressed because of course also the cost of buying their energy products also increased, and I do expect them to maybe increase this a little bit again back to the at least double-digit range. Looking at the debt on their balance sheet, we can see 610 million here in 2013 and just over 2 billion in 2022, growing in line with EBITDA, which is definitely not a bad thing to see. I think the moment that a company grows their debt in line with EBITDA, I think I'll be happy owning that company. But on top of their relatively low debt growth, we also see a big surplus of excess cash here on their balance sheet. We see 343 million in 2013 and 805 million here in 2022. So if they want to, they can basically buy back a large portion of their debt, making this a very unleveraged business and making this a relatively safe investment for you as an investor, because there's probably not much risk of bankruptcy. Market cap, so the price on the open market itself, so the amount of shares multiplied by the price of those shares, and then you get the market cap, and this number has been increasing by 5.7% every single year. Enterprise value in the meantime has increased by 8.3%, so quite a bit faster than their market cap, because their debt level has been growing faster than their market cap has, so therefore you see a bit of a difference between these two numbers. Enterprise value, of course, is the entire value of the business. So you take the market cap or the price on the open market itself, and we add the debt and we subtract the cash. Of course, debt is very much a part of a business, and I always want to include it whenever I make a calculation based on valuation for any company. So therefore, I want to look at enterprise value as opposed to market cap to include the debt and include the leverage that a company might have. EV/EBITDA ratio, this is the amount of years it takes for their earnings, so the earnings before interest, taxes, depreciation and amortization. How many years of EBITDA are required for them to buy back the entirety of their enterprise value? And we can see here that on average for the past 10 years, they've been circling around the 9 times range, where for the past 2 years, they've been circling around 6 times. So I think compared to the historic average, they are definitely a lot lower right now in valuation than they were historically. And I think there's definitely a possibility for Rubis to see an expansion multiple, to see their share price increase to go back to the norm of around 9 times. So just looking at their ratio here, I do expect that we can see some fruitful gains from this multiple expansion. Net debt to EBITDA ratio is on average about 1.1 times. So this is where we take the debt level, we subtract the cash, and we see how many years of EBITDA are required to pay back the net debt that a company has. And because Rubis has quite a lot of cash on their balance sheet, it takes them in 2022 only 2 years to pay back the entirety of that debt. Whenever we look at companies, we always want to have a company that's below the 3 times range, because after that debt is more expensive, and after that the company is in more risk of bankruptcy. But for Rubis, that is not at all the case. So this then brings us to the cash flow statement, and we can see here for cash flow from operations that their cash flow has been increasing by 14% every single year, in line with the EBITDA numbers, which is always very nice to see. The moment that these two differentiate too much, it means there's something fishy going on with the accountancy practices of the company, and you always want to have a bit of a deeper dive in exactly how they get those numbers. But for Rubis, they are relatively equal, so that's definitely a nice thing to see. They also mentioned in their annual 10K that they are also now producing energy. Before they were just distributing and supplying. Right now they're also producing renewable energy. And the goal for them is to have 25% of their EBITDA to be coming from their renewable energy. Right now, just looking at their 10K, I noted that their renewable energy section accounts for 3% of their EBITDA, so 18 million over an entire number of 669. So they're nowhere close to the actual number that they're aiming at, but this does show to me that they are very much moving towards the renewable section, moving towards basically future-proofing their own future, because of course energy from gas and oil may not be as lucrative in the future as renewables are, and Rubis very much want to play into that field as well. So if you're also a bit into the renewable energy, because you're a bit more of an ethical investor, then I do think that Rubis right now may be a bit of the dangerous territory, because of course they do deal in fossil fuel energies, but in the future they want to transition more to renewables, and that's also where a lot of their investments are going towards. You might have noticed that in 2022 they really spiked up that debt level, and this is because they're very much investing into renewable energy. If that's something that you want to advocate as well, something that you very much want to support, then I do think that Rubis may be an interesting company for you here in the future. Capital expenditure, so all the amount of money they have to put into the business to try and future-proof their operation. This means additional storage facilities, pipelines, anything that they require to keep on running their business as they currently are. And we can see that capital expenditure is increasing by 10% every single year, and their cash flow is increasing by 14%. So their margins here are once again definitely increasing. If we take their cash flow from operations and we subtract the capital expenditure, we get their free cash flow. This is the amount of money available at the end of the year for you as an equity owner, and they can use this money to, of course, make additional acquisitions or expand their operations when it comes to their renewable energy ambitions. But they can also dividend this out, and they can also buy back shares. Rubis right now, if I take a quick look at the open market, they pay a dividend of 8.5%. So most of their free cash flow actually goes to paying a steady dividend, which if you are a dividend investor, I think it's a very lucrative and nice number to gain 8.5% of your initial investment back. Of course, if they actually use this money to expand their operations, they would see a higher EBITDA. So there's always a bit of pros and cons when it comes to dividends, because of course the moment that they give the money to you, they can't use the money to expand their own operations, and therefore future profits may be more limited because of it. But if you are a dividend investor and you're chasing those high yields, I do think Rubis may be an interesting company for you. Shares outstanding. Now this is one of the things that I don't like about Rubis, because one of the reasons that they very much maintained a very low debt load is because they mostly finance their operations by diluting their share count. They're basically just putting more shares on the open market and selling those, and this is how they get most of their funding. So even though their debt is very low, they obtain their money by selling shares to investors, which dilutes your percentage ownership of the company. If you owned 1 share of Rubis here in 2013, you owned about 1.5% of the company, whereas now, about 10 years later, you would only own 1% of the company, simply because they're diluting the share count and bringing more shares to the open market. I would very much like to see them actually buy back some shares from time to time, because they've been increasing it by 5% annually, which I think is quite a high number. numbers. So this is definitely my one red flag that I have for this company, is that they may not always have their investors in mind when they make certain choices. This then gets us to a free cash flow per share. So the moment that we take the free cash flow and divide it by the amount of shares outstanding, we get free cash flow per share. And we can see in 2013, because they had a low free cash flow, that we see a free cash flow per share of about 23 cents. They also had an absolute amazing year in 2020, where they see a free cash flow per share of $3.33, euros I should say actually. They are located in Paris, so of course we're talking about euros, not dollars here. Very attractive, 21% increase, mostly because the first number is quite low. If we normalize this to €1, we see a way different picture. So this then kind of brings us into the business of trying to forecast Rubis into the future. And whenever I make a forecast, I always want to be a bit more conservative to make sure that I've got some leeway when the stock goes south or the performance of the company goes south a little bit. Some additional cushion to really take any blow that might come my way. So when it comes to the enterprise value model, I took their EBITDA number of 2021 because I do think that 2022 is highly influenced by the high energy prices in Europe, and therefore I actually don't imagine that they can maintain this level of EBITDA. So for their projection, I'm going to take their 2021 number, which I think is more in line with their annual growth rate here for the past 10 years. And I definitely think 2022 is an outlier. Of course, they can surprise me, it's always possible, but I want to be a bit more conservative with my estimates. So I'm going to take this number and grow it by about 8% every single year, which is about in line, I think, with their overall 10-year average. Even though it shows 12%, it's mostly influenced, of course, by this last number. If we normalize it, we see around the 10% range. I'm going to be a bit more conservative and say 8% because I do think that fossil fuels may not be as lucrative here in the future. Although, of course, I do very much like that they're going into renewables as well. But just to have that additional cushion again, I'm going to give them 8% EBITDA growth. And I'm going to give them this 8% for the first 2 years, and then I'm going to drop it to 6%, as I do think that fossil energy may be less lucrative, and I want to account for that. So for the 6 years in between, I'm going to give them a 6% growth and then a 4% growth, which I do have to say is a very conservative, maybe even pessimistic view of their earnings. It may be a lot better than this. I think it very well would be. But I want to be extra cautious here with my projections because I'm not sure exactly where this company might go. I am going to give them a market multiple of 9 times, which is their historic average. Right now they're trading at 6 times, so I very much expect them to have a market multiple increase of 3 times, which will very much favor the stock price here. So this gives me an enterprise value 10 years from now of 8.5 billion euros, from which we subtract the debt, we add the cash, and then we get a market cap of about 7.3 billion. Divide this by the amount of shares outstanding, and I'm assuming that the amount of shares outstanding remain the same. Looking at that 10-year history, I actually expect them to keep on diluting the shares, which I'm not a fan of. I do want to reiterate, instead of paying an 8% dividend, I would have liked to see them pay a 4% dividend and use the rest of the money to actually buy back shares, or at least remain it neutral. But this is not what they're doing. They're very much diluting their share count. So of course, this might influence the projection, but I can't really go ahead and spend their free cash flow for them, so I'm going to remain them stable. This gives me a stock price 10 years from now, so in 2032, of €70.70. For their free cash flow model, I'm going to do a very similar thing. I'm going to take that number from 2022, which I think is like in the middle of where we see most of their free cash flow per share be, and I'm going to grow this by 8% for the first 2 years, then 6% for the next 6 years, and then 4% for the last 2 years. I'm also going to attach a yield of 5%, which is their historic average, so I'm just going to take that number and project it forward from there. This gives me a stock price 10 years from now of €56.29. Looking at the open market right now, I can buy as many shares as I want of Rubis for €23.76. Taking both my projections, so the enterprise value as well as the free cash flow model, I get an overall share price 10 years from now of €63.50. This gives me a compounding annual growth rate in the stock price alone of 10.3%. And this is very much influenced by the market multiple expansion that I expect Rubis to have here. They're currently trading at 6 times. I expect them to go back to 9 times. They've even been as high as 13 times. Now I think that's a bit lucrative, but I do definitely think 9 times is a reasonable assumption to have. So this is very much influenced by that. Of course, the moment that we also include the free cash flow that we can expect to receive from Rubis, the 8.5% dividend yield basically, based on the free cash flow that we projected here in the free cash flow model, I expect an internal rate of return of 19.2%. which is a very, very good return, especially considering the relatively conservative estimates I have given Rubis here when it comes to their EBITDA growth. So I definitely think there is more in store for Rubis if they can actually beat these numbers, which I think they will be able to do. So then we can see an even higher return in the future here. But let's see what happens if the price goes up or comes down a little bit. So the moment that the price goes down to, let's say, 17 euros, I expect an IRR with my current calculations of 25.7%. And this is with relatively conservative estimates. If the price goes up a little bit, so back to the 30 euros range, I still expect an IRR of around 15%, which is still market beating. On average, the market returns about 10% every single year. And even if the price goes up by a bit, I still expect Rubis to outperform the market. Of course, just looking at their share price, we can see that they've traded at 60 euros here in 2017. And they dropped all the way to 24, which is definitely very much a low point here. And I think the moment that Rubis can maintain their EBITDA and revenue numbers, I think this price will definitely come up to the average multiple that we see here of 9 times. So that was it for Rubis. Thank you very much for watching this video. I'm looking forward to celebrate the next 200 subscribers with you somewhere in the future. So thank you again, and I'll see you in the next one. Cheerio!